Take a look at the screen because what you're seeing is basically the Fed's worst nightmare. Today, we're going to spend a little bit more time breaking down the stagflation trap as well as the silent flip happening in Bitcoin and nobody's noticing. On the left, stocks are at all-time high because everyone thinks the Fed is about to save us with massive rate cut. But on the right-hand side, we got ourselves a poison pill. So far, we've only added 50,000 jobs in December, and this low-key screams recession. But look closer. Unemployment rate sits at 4.4%, slightly lower than the forecasted 4.5%, while wages went up by 0.3%. And if that's annualized, we're talking about 3.6% wage growth, and that is way too hot for the Fed's 2% inflation target. So the Feds are basically being sandwiched now. The economy is slowing down, but inflationary pressure is still sticky. If the Fed cuts rates to fix the job, that wage pressure could spiral into real inflation. If they don't cut it, the recession gets worse. The stock market seems to be pricing in a fantasy right now because a lot of people think that the Fed is going to cut rate aggressively this year. While that might be true, we've got the Fed governor openly calling for a large basis point cut in 2026. Now think about that. When a sitting Fed governor is basically shouting that we should emergency cut because the job market is dying, it's kind of scary. But here's the poison pill. Wages are still rising. But you might be asking, isn't getting a raise good? Well, for us common people, yes. But for the Fed, it's a nightmare because if wage growth stays hot, the inflation pressure could remain kind of sticky. So if the Fed cuts rates to save the job market while wages are still going up, they're basically pouring gasoline on fire. And that might just reignite the same inflation crisis we just spent 2 years fighting. So the Fed is trapped on the monetary side. But if you look at the government side, it gets even worse. We're staring down a government shutdown in less than 3 weeks with funding expire on the 30th of January. On top of that, the president just tried to freeze $10 billion in spending, but a judge blocked it on Friday. So now the White House is fighting the court and the Congress is fighting the clock. Now, I don't know if you do see the setup, but the Fed can't cut because of inflation and the government can't spend because of gridlock. So we're basically looking at a system that is paralyzed. And then we have the trade war. A couple days ago, the Supreme Court delayed the ruling on Trump's tariff. So again, we're once sitting in a legal limbo. We now have a threat of 500% tariff on specific nations like India and China if they bypass sanctions. And don't forget this, tariffs are inflationary because they raise prices. So walk through this logic with me. If wages are rising, tariff might hit 500% and the Fed wants to cut rate, we could be walking straight into a hyperinflationary storm. But the market is acting like everything is fine. And that could be why the whales are pinning Bitcoin right here, because they know a potential way to get out of this paralysis is eventually printing more money. Right now, Bitcoin feels boring. It's pretty much just chopping around the 90,000 range. But look at the heat map. If you see those bright yellow bands, that's the big money liquidity. Price is currently sandwiched between a buy wall at 90,000 and a sell wall at 92,000. Now I believe this isn't random. The price is being squeezed here on purpose. Well, you might look at the candle chart and get bored. Smart money might be looking at this as a potential loading zone. They're keeping the price flat to fill their bags before the real move happened. So how are the big boys positioning for this mess? Let's take a look at the open interest. It seems like the battlefield now is all about CME versus Binance. Now CME is where Wall Street suits trade, and Binance is where the global retail degens like you and me trade. And right now, they're going at each other's neck. Now get this. This is huge because in previous cycle, retail ran the show. Now Wall Street is matching us dollar for dollar. The institutions aren't just watching anymore. They're trying to drive the car too. So let us address the elephant in the room. The ETFs are looking red. But the red bars might be lying because the money might have not left crypto. It could be a lane switching because while the ETF buyers are getting scared by the macro news, the future giants on CME might be secretly stacking. Next up, the demand isn't just coming from the US. We have a second engine firing up in 2026. Now let's take a look at Asia. South Korea is moving towards spot Bitcoin ETFs as part of their 2026 strategy. Now if you know crypto, you know them Korean investors don't mess around. When they buy, the price moves fast. Now finally, let's check the vibe. Are people getting too greedy? We'll take a look at the funding rates. Bitcoin is sitting at a baseline, and this is pretty healthy, meaning nobody's going crazy with leverage yet. For Ethereum and altcoins, this means we have some room to run if Bitcoin continues to hold that 90,000 level. But remember, if that poison pill that we just talked about hits, meaning that if we get recessions and inflations, alts will bleed first, and Bitcoin is probably going to be your shield. So here's the reality. The economy is walking on a tightrope. 50,000 jobs says recession, but rising wages says inflation. The Fed is pretty much in a lose-lose situation. Now, if they print money, inflation comes back. But if they don't, the economy stalls. And this could be why the institutions are buying, because they know that in a world where the central bank is trapped, you need an asset that you just can't print more. And this brings the conclusion to Bitcoin. That means Bitcoin could be the exact lifeboat built for this specific storm. Now the question is, are you watching the fear or are you watching the flows? Alright guys, happy Sunday, and that's what I have for you guys today. Now don't forget, the upcoming week is going to be critical for market volatility. We have the CPI data dropping on Tuesday, followed immediately by the PPI on Wednesday. But Thursday is going to be the real liquidity test because we have the jobless claim in the morning and the Fed balance sheet update in the afternoon. So if we see liquidity draining while unemployment rise, things could get ugly really fast. So remember, trade safe, and I'll see you in the next one.